Well, we can now go back to Marc Faber, who joins us on the telephone from Chiang Mai in Thailand. He is the publisher of the influential Gloom, Boom and Doom report. So hopefully we can hear you a bit better now, Marc. Thanks again for being with us. Give us your reaction to the BOJ's action this morning.
Well, as I said, I don't think they are surprising as little as the speech of Mr. Bernanke in Jackson Hole was surprising, in the sense that as the economy doesn't recover much, the central banks around the world will print money, and nobody really wants to have a strong currency. What is more important to recognize is the impact on asset markets.
Okay, what is the impact?
Well, I think last Friday was a very interesting day. First of all, we had over the last 10 days a lot of negative news and front-page articles about the Hindenburg omen. And on Friday, we had a headline in the London Telegraph that the market strategists expected the S&P to drop to 450 and so forth, and that government bonds would continue to rally. And on Friday, we had a key reversal day where stocks closed up strongly on the day after having been down in the morning, and when bonds tumbled.
Okay.
I think to understand, the market, in my opinion, will perceive easing moves by central banks around the world as being inflationary. For asset markets.
Okay. All right, Marc, please stay with us. We're going to come back to you after this very quick break. By Marc Faber, who's in Chiang Mai, Thailand. He's the publisher of the influential Gloom, Boom and Doom report. Well, Marc, this is just where we left off, talking about asset bubbles. What do you think?
Well, I think that money will flow into equities, at least for the next couple of weeks, and into commodities. And it is a fallacy to believe that easy money and the purchases of treasuries will boost economic activity in the United States. Because if you look at the last 2 years, we eased massively in the U.S. We had fiscal deficits. And where did growth take place? In Asia. And so when we talk about job creation, do you think that Intel or a small businessman will hire more people in the U.S. because of further monetary printing? No, they won't. They will build factories in Asia, and they will hire people in Asia. And so all the monetary policies in the U.S. do is create misallocation of capital and unintended consequences.
Now, is one unintended consequence a bubble in treasuries, do you think?
Well, let's put it this way. The treasury bond market, the 30 years and the 10 years, have been rallying now for close to 30 years, since September 81. We are close to all-time lows in treasury yields. And in my view, for the next 10 years, to be in treasuries will be a disastrous investment. Because if the economy weakens, and Mr. Bernanke has said it and emphasized it, they're going to print money. So eventually, and last Friday was a good indicator, what happened is bonds tanked and stocks went up. Eventually, the bond market will see through the money printing that will eventually lead to inflation somewhere in the system. It can be asset inflation, could be in stocks, could be in commodities, could be again in real estate, which I doubt, but it could also be in commodity prices that then lift consumer prices and lift import prices.
So, Marc, how do investors shield themselves from these inflationary pressures? Where should their money be right now?
Well, I believe that people should own essentially agricultural commodities, or ideally a home in the countryside or a farm. I think they should have some money in equities, because in a money printing environment, what happens is that the economy goes south, the real economy goes south, and the financial asset markets go up, except for bonds. So I would disagree with the super bears. I see the Dow at less than 5,000 and the S&P at 400. I would rather think that the risk would be to put all your money into U.S. Treasury notes and bonds of longer dated maturity.
Okay, Marc Faber of Marc Faber Limited, we thank you very much for joining us.